If you already own SCHD, the Schwab U.S. Dividend Equity ETF, congratulations! You've got one of the most consistent, reliable dividend machines in the market. But here's the thing. While SCHD is a powerhouse for stability and long-term dividend growth, it's not designed to explode your returns. It's steady, not speedy. So in today's breakdown, the focus is on how to complement SCHD, not replace it, to create a portfolio that's both stable and primed for explosive growth. The goal is to understand how a couple of well-chosen ETFs can balance SCHD's weaknesses and deliver the best of both worlds, reliable income and powerful compounding over time. SCHD tracks the Dow Jones U.S. Dividend 100 Index. It focuses on large-cap U.S. companies with consistent dividend histories, solid balance sheets, and high free cash flow yields. We're talking about names like PepsiCo, Merck, Coca-Cola, Home Depot, and Broadcom, companies that have proven resilience through economic cycles. The fund yields around 3.5 to 4% and has a 10-year dividend growth rate near 12%. Its expense ratio is incredibly low at just 0.06%, with minimal turnover, meaning you're not paying for constant buying and selling behind the scenes. What makes SCHD stand out is its disciplined structure. It screens companies that have paid dividends for at least 10 years and ranks them using metrics like return on equity, dividend growth, and cash flow to debt ratios. Those that make the cut are weighted based on their dividend yields. This structure creates a steady, income-focused portfolio that moves slower than the S&P 500 during bull runs, but holds its ground better in corrections. It's perfect for long-term investors who value predictable cash flow and low volatility. However, SCHD's main limitation is its underexposure to growth sectors, especially technology. Tech makes up only around 13 to 15% of its portfolio, while in the S&P 500, it's over 30%. That means investors miss out on some of the fastest-growing segments of the economy, especially in times when innovation drives market returns. To fix that imbalance, two ETFs can work alongside SCHD, funds that inject growth and innovation into your portfolio without compromising its core stability. The first ETF to complement SCHD is VGT, the Vanguard Information Technology ETF. If SCHD is your income engine, VGT is your rocket fuel. VGT tracks the MSCI US Investable Market Information Technology 25/50 Index, which includes nearly every major American tech company, from giants like Apple, Microsoft, and NVIDIA to smaller innovators like Intuit and ServiceNow. This fund delivers exposure to the core of modern economic growth: semiconductors, software, cloud computing, and AI infrastructure. SCHD and VGT balance each other beautifully. SCHD is light on tech, while VGT is entirely tech, so you diversify across economic sectors. Historically, VGT has returned around 18 to 20% annually over the last decade, roughly double SCHD's rate. Even a 25 to 30% allocation to VGT can significantly lift overall returns. Though it's more volatile, SCHD's steadiness cushions the swings. Together, they actually reduce total portfolio volatility compared to holding either one alone. VGT's yield is modest, around 0.8%, but its dividend growth rate is impressive. Tech firms like Microsoft and Apple have raised their dividends aggressively, often outpacing traditional dividend stocks in growth. Over time, that helps close the yield gap and adds a powerful compounding effect. If SCHD represents the legacy of corporate America, VGT represents its digital future, and every balanced investor needs exposure to both. The second ETF that pairs brilliantly with SCHD is QQQM, the Invesco NASDAQ 100 ETF. QQQM is essentially a more affordable twin of the popular QQ fund, with identical holdings but a lower expense ratio of just 0.15%. It provides exposure to the NASDAQ 100, the top non-financial innovators driving global markets, including Apple, Microsoft, Amazon, Meta, Alphabet, Tesla, and NVIDIA. QQQM adds explosive growth potential while complementing SCHD's defensive characteristics. SCHD gives you value and cash flow. QQQM delivers growth and innovation. Together, they smooth out performance across market cycles. When rates are high and value stocks outperform, SCHD leads. When liquidity rises and tech booms, QQQM takes over. Historically, QQM's annualized return exceeds 15% over 20 years, proof of how innovation and compounding can dominate in the long run. Think of SCHD as your defensive line and QQQM as your offensive playmaker. The balance between the two is what drives superior long-term results. Now, how do you combine them effectively? There's no one-size-fits-all approach, but the strategy depends on your goals and risk tolerance. For conservative investors focused on income, a 70% SCHD, 20% QQQM, and 10% VGT mix works beautifully. You get solid dividends, moderate growth, and minimal volatility, perfect for retirees or dividend reinvestors. For balanced investors, a 50% SCHD, 30% QQQM, and 20% VGT allocation tends to outperform. Backtesting shows this blend more than doubled SCHD's total return over the past decade while keeping drawdowns manageable. Finally, growth-focused investors who can stomach more volatility might go 40% SCHD, 35% QQQM, and 25% VGT. This allocation favors aggressive compounding, ideal for younger investors with long horizons. The power of this trio lies in its synergy. SCHD smooths the rough edges of QMU and VGT, while those two drive overall performance higher. Together, they create a portfolio that's resilient, yet opportunistic, the kind of setup that thrives in both bull and bear markets. Let's look at performance data. If you'd invested $10,000 in SCHD back in 2013, it would have grown to around $34,000 by 2024, a solid 240% total return. But if that same $10,000 were split between SCHD, QQQM, and VGT in a 50-30-20 mix, you'd now have over $61,000. That's almost double the outcome with only about 15% more volatility. It's not just about taking more risk, it's about taking smarter, diversified risk. SCHD's correlation with VGT sits around 0.75, meaning their movements aren't perfectly aligned. That's good. It ensures diversification works in practice. When one lags, the other often leads. The same goes for QQQM and SCHD. This correlation structure builds a portfolio that's less likely to sink all at once during downturns and more likely to capture gains when conditions shift. What about income? Many investors worry that adding growth ETFs like VGT and QQQM reduces their dividends. It's true your starting yield will drop slightly, from around 3.8% with pure SCHD to about 2.5% combined. But your dividend growth rate accelerates dramatically. SCHD's dividend growth is already strong at roughly 12% annually. QM's dividends have grown about 14%, and VGT's a staggering 17%. Reinvesting those growing payouts can actually deliver higher future income than SCHD alone after several years. Cost efficiency is another strength. SCHD charges just 0.06%, QQQM 0.15%, and VGT 0.10%. Weighted together in a 50-30-20 blend, your total expense ratio hovers around 0.09%. You're accessing hundreds of top-tier companies across multiple sectors for less than 0.1% annually, far cheaper than most mutual funds or actively managed portfolios. To keep the balance intact, rebalancing once or twice a year is enough. When tech rallies too far ahead, trim 5 to 10% from VGT or QQQM and reinvest it in SCHD. When value and dividends lead, shift back toward growth. This small, disciplined act of rebalancing helps you buy low and sell high naturally, maintaining a stoic approach that resists emotional swings. Of course, every portfolio carries trade-offs. SCHD tends to lag when interest rates rise sharply because high-yield stocks become less attractive compared to bonds. Meanwhile, QQQM and VGT can stumble when tech valuations stretch too far or when liquidity tightens. The key is that their risks don't overlap perfectly. When one struggles, the other often holds firm. Take the case of David, a 35-year-old investor who started in 2016 with 60% SCHD, 30% QQQM, and 10% VGT. Over 8 years, his average annual return was nearly 14%, beating the S&P 500 and SCHD individually. During the rough 2022 market, his portfolio fell only 17%, less than both SCHD and tech-heavy portfolios. When markets rebounded in 2023, his growth allocation helped him recover faster than pure dividend investors. It's the combination of offense and defense that delivers consistent success. Looking forward, this approach fits perfectly with where markets are heading. The coming years will see alternating cycles of growth and value leadership. High interest rates, AI expansion, energy transitions, and shifting trade dynamics mean the winners won't always be the same. SCHD anchors you in cash flow and financial strength. QQQM captures the innovation driving new wealth. VGT zooms in on the cutting-edge tech infrastructure that powers it all. This blend thrives across regimes: inflationary, deflationary, expansionary, or recessionary. When rates fall, tech surges. When rates rise, dividends and cash-rich companies protect capital. Together, the trio provides both resilience and reward. If this breakdown helped clarify your next move, make sure to hit the like button, share it with fellow investors, and subscribe for more research-based ETF strategies. The best investors don't chase hype. They combine logic, patience, and diversification. That's how you turn stability into power, and power into lasting wealth.